Good afternoon. My name is Bruce Bolger. I'm the founder of the Enterprise Engagement Alliance, and I'm very pleased for you to join us either on this live show or on this recorded show that'll be posted shortly on the EEA's Human Capital Enterprise Engagement YouTube channel. We're very lucky today to have experts on a subject that I don't think could be much more important than materiality and the disclosures of human capital. Yes, it sounds like a fancy, complex concept, but material has a very clear term meaning, meaning that it has a significant impact on circumstances. And we'll be talking about that today with people who know more than I. So I'd like to introduce our speakers, starting alphabetically with Larry Beeferman. He's head of the he's a fellow at the Worklife Program at the Harvard Law School. He's also an independent consultant with extensive experience on pension design and management with a special interest in human capital, workers' rights, and infrastructure. Neil Buckspan, and I hope I'm pronouncing that properly. He's our only tri-coastal guest here today. Larry's in Cambridge. I believe that Neri has locations in Tel Aviv, New York, and Los Angeles, but currently in the New York area. And he is a partner in the accounting practice for Ernst & Young with expertise in reporting and governance and financial involvement in financial accounting advisory service. And before that, he was with, I believe that was with Standard & Poor's, where he served as a chief risk officer. So he has plenty of experience in the domain of materiality and reporting. And finally, we have Dr. Solange Charas, who's a professor at 3 different universities, Columbia, University of Southern California, and New York University. And she has had extensive experience in senior HR positions and now is chairman of HCMoneyball, which has a human capital analytics platform that's very relevant to this discussion as well. So just to give you a quick idea of who is sponsoring this event, it's our organization, the Enterprise Engagement Alliance, is all about fostering helping organizations foster the proactive involvement of all people critical to success. We're founders in the concept of stakeholder capitalism, having been founded in 2008, and we provide learning and certification. We have an online trade publication, enterpriseengagement.org, provide a marketplace of solutions, EEX advisors, certifications and ISO standards, and we provide advisory services and books. And we do have sponsors who we always like to recognize, EGR International, which is an organization that helps companies harness the power of inspiration, BCAT, a brand alignment company, and Merit CX, a leading voice of the customer company. And with that, I am going to stop sharing the screen and proceed into our subject matter. And I'd like to start with Solange. Solange, you've been tracking the whole concept of human capital for years as an HR professional. And I think we can all agree that very few major companies have sophisticated human capital dashboards and strategies against which they measure. Do you believe that the Securities and Exchange Commission regulations that now require human capital disclosures in effect means that human capital is material and should be considered as such?
Well, yes, I do believe that human capital is material in certain instances. And I think that's the debate today, is to try to help organizations figure out when human capital is material and how to measure that and how to report that in a responsible way. Before we get going, I just wanted to thank you, Bruce, for including me in this panel. I'm honored and thrilled to be speaking with Larry and with Neri. These are 2 voices that I have been following, and just delighted to be part of this. And to answer your question, I think that most organizations, especially large organizations, have been introducing rigor and approaches to actually measure their human capital performance at the program level, to understand whether or not their performance management system works, or their training and development systems work, or their compensation systems work. But the missing link is really understanding how that impacts the organization at the enterprise level, and what impact that has on corporate financial performance. And my focus is to really understand how human capital in its totality, in the aggregate, is correlated to corporate financial performance trends, and how that benchmarks against other organizations in the same industry, to see how an organization's performance is benchmarked against their competitor group.
Neri, you have an opportunity being at the front lines of helping major corporations manage complex accounting issues. How much do you think organizations today are taking into account these human capital issues and making core decisions in the same way that they use financial information to make core decisions? This concept of linking the large amounts of money that's spent on human resources, incentive programs, recognition programs, all the types of things that in your EY report on the SEC rules lays out. How many companies are really looking at the ROI and how those drive organizational performance?
So it's a very instructive question, because as we know, measuring the unmeasured is something we all learn, and I do think being an accountant, accountants always were challenged with intangibles, as you know. We have difficulties in measuring R&D. This is why we are expensing R&Ds, and there's some conservatism that always has been done to accounting. So fortunately or unfortunately, accountants were never tasked with measuring human capital appropriately as an asset or ROI. In fact, the traditional accounting system using the amount spent on human capital as an expense. So you're speaking with an expense at EY rather than an asset. Having said that, if somebody looks at the capital markets and say, okay, what's a market capitalization is with company that have significant human capital content and what it is, one can assert that it has significant value. So one thing you would suggest, an ROI on human capital is that should be of utmost interest to managers, to organization, to the market at large when they invest in companies. And the nature of ROI, I would suggest, is measured by some of the most advanced companies. I think the measurements are still, to some extent, fuzzy. It's difficult to articulate, but as you start thinking about what programs are directing capital to, how do I hire, how do I incent, how you build up those measures, it's being measured. Now, how effective it is, how consistent it is, how harmonized it is, and whether you have one measure that, and by the way, there are measures that I think Larry can speak to, or others, and Solange, that deal with return on human capital, that have been more robust or more rigorous than others. I would suggest most companies are not looking at the traditional measurements. Just, today I can you wake me up in the morning, and I know what's my ROIC on human capital. I just don't believe it to be the case. Having said that, it's not that companies are ignoring it. It's just the fact that it's difficult to measure. It's an evolving area, and some of the metrics and the measures vary. So I don't know if it's answered your question, but I do think it's accounting for human capital is an evolving practice. The one thing I would add to it, Bruce, which is in my mind most salient, is the human capital content become ever more relevant in our economy. So if you think about what were the inputs and what was the role of human capital in the industrial world when the SEC rules started to promulgate in the 1930s and 40s, the environment has changed as far as content. And I think this is changing what we are seeing today and will change in the future to get presumptively to where you're describing.
Well, we're going to get back to you on that. Larry, you've been following this for years. I know that because I've written about your work. To what extent do you think organizations, where are we on this learning curve of understanding the materiality of human capital? And we're going to talk later, and we'll have time, about how this actually relates to current events and decisions. And do you think, two questions, how are we in the maturity scale of the vision that Solange beautifully started this session with, linking what I'm doing to manage people to my organization objectives and to my financial goals? To what extent do you think that we are in the maturity scale, and do you think the SEC requirements and even the World Economic Forum stakeholder capitalism metrics are pushing this along?
Well, I guess it depends on maturity from whose perspective. I mean, the insights that I have relate less, I think, to the kind of experience that Solange and Neri have in terms of working with companies. The most insight I have is from the academic literature, which was a study which we did several years ago.
Which is why you're here, Larry, by the way, so
yeah,
appropriate.
So let me just sort of briefly start from that I can sort of generalize. I mean, I guess, number one, the academic literature we looked at, the weaknesses of that literature, such as they are in part, I think, precisely because there's relatively little public disclosure. That is, if you look at the studies, a lot of them rest on special surveys and questionnaires. They don't relate to systematic information gathering. So I think that's a real problem from the get-go. All right, so what we did a few years ago was look at all the academic papers that were concerned only with the following: the relationship between one or another workplace policy or practice, if you will, and financial performance, understood from an investor perspective, whether it be shareholder return, return on investment, Tobin's Q, whatever the financial characteristics. We did not, there are a zillion papers that might look at productivity, that might look at some intermediate factor that has some ultimate bearing on financial performance. But we were only, because our work related to investors primarily, we want to look at it from that perspective. So we took a subset of those. We excluded health and safety conditions, for which there's a vast literature. Although they're very interesting, you find very, very, very few papers that relate health and safety attributes or characteristics to financial performance. Another conversation. The bottom line was, so to say, that of the studies we did identify, a large fraction of them established the correlation between one or another workplace policy or practice and financial performance defined in those terms. There was a smaller subset for which there were mixed results. Some factors were positive, some were negative, and some showed no net effect. Only one of the studies, only one study showed a negative effect. So you have a small subset for which there are mixed results or no results. So broadly stated, but certainly that academic literature, insofar as we surveyed it, showed that there was this correlation. Beyond that, it's sort of interesting in terms of the character of the studies. Interesting, a great fraction of them were concerned with training, and training described in a multiplicity of ways. The expenditures on training, the relative number of people trained, the number of hours of training, the character of the training, etc. A lot of studies, but which established correlations in that sense. And then there was the other set of studies involved other workplace characteristics and attributes. But I think one thing that was very interesting that came across, at least in this literature, was the sense that if you're talking about ultimately financial performance, you need to look at clusters of policies and practices. That is, the rubric they use are bundles of interrelated policies and practices which combined in some causal way produce the results that we're looking at. And there's some interesting...
So Larry, if I can interrupt you on that, so what you're really saying is that a strategic and systematic proactive approach rather than reactive, ad hoc, throwing something at the problem.
Yeah, that is, it can't be one-off, if you will. This particular attribute of that focus on training, again, you can learn something from that as such, but you really have to have a, I'll call it an integrative, multifaceted perspective in terms of really seriously, as far as I can see. If you want
now, Larry, we have to move on because of a tight time, but I wanted to ask you before I go to Solange, in the second issue of the SEC and the Securities and Exchange Commission, and Neri, I'm going to get to you on this as well. The issue of materiality, the issue now that companies, again, using a principles-based approach, they can say pretty much whatever they want to say, but with the proviso that it's to the extent that it's material to their business, right? So obviously today, people, for reasons that Neri said, intellectual capital now is a critical part of goodwill today, right? So do you think that this will apply pressure for instance, you've often represented the interests of investors. Do you think you're seeing more pressure from investors? They're going to ask questions. what exactly, are you doing? Neary's, we're going to get back to Neary, but EY has made concrete recommendations as to what companies have to or should publish. Do you think that the SEC will advance this, and maybe in 4 years, these studies, if you do this study again, it will look different? That's a question to you.
To Larry, to me?
Yeah, to you, Larry. I'm sorry. Do you think the SEC will have an impact on the thinking, that this will move it along?
Yes, but I think more generally, the SEC is part of a trajectory of attention, all right? And certainly the specific action the SEC take is going to be a significant spur to that, one way or another, A. And B, I think one way or another, by virtue of what the SEC has done and other initiatives, there will be more disclosure. And I think the potential character for studies by academics and others will be much greater and more productive.
So Solange, from your standpoint, at the end of the day, what is the real impact of this? Of the idea of what Larry is saying is true, and I think many other people believe that, and we're going to get to Neary on that also, then wouldn't it seem that companies spend an enormous amount of money on incentive programs, recognition programs, these sales incentives, and all sorts of things to motivate people that, to my experience, have no ROI measurement. They are ad hoc and reactive in the way that Larry stated, and that they're done because we've got to do something, but it's a sunk cost, so, we're just going to budget for it and hope it goes well. That's the way I see it. Would you agree that that characterizes a lot of companies, and could this change that thinking?
Oh, it's absolutely going to change the thinking. And let me just refer to what you talked about right now, which is the sunk cost. Forever, and Neary can speak to this, human capital expense has been thought of as an expense. It is, that thing that we know, the necessary evil. We have to spend money on people, but we're hoping for our return to come in different areas of our investments. And what's very interesting about what the SEC did is they are recategorizing human resources, not exclusively as an expense, but as an investment in an intangible asset. And that's going to change the nature and the characteristic of the way that we think about human capital, because it is now making an investment in an intangible asset. And if you connect the dot between that and the fact that Ocean Tomo did research on the S&P 500 companies and are concluding that 90% of market value of those S&P 500 companies are from the intangible assets of the organization. This is enormous. This is no longer shove human capital expense to the side and let's worry about the other parts of our business model. This is putting human capital front and center as an investment in an intangible asset that in most instances could make up 50% or more of our market value. We have to think of it. We have to contextualize it differently. The SEC said this 4 months ago. Do I expect companies to turn on a dime and to all of a sudden wake up one morning and say, oh, I'm going to think about human capital differently? No, it's going to take time. But what Neary said in a conversation that we had before this, which so resonated with me, it's not about the disclosures. It's about the insights that you get about your business effectiveness. We shouldn't be focusing on what we need to disclose. Of course, that's an outcome. But more importantly, we should understand how our human capital performs so that we get insights about our own business so that we can make decisions better. And I'm just going to cite Roberto Romano, who coined the phrase quack corporate governance to describe Sarbanes-Oxley and Dodd-Frank. They were too prescriptive. It turned into a check the box and it lost the spirit of what that legislation was about. So there are many detractors about the SEC basically not putting any, prescriptive measurements there. I actually applaud them because then each company can determine on a principle basis what is material to their organization, how it should be contextualized and managed. And that's responsible. We have a responsibility to the investor, to you know, the other constituents that are defined by the new purpose of the corporation, by the Business Roundtable, our employees, our communities, our business partners. It's changing the way we think about business and transforming it from just a profit seeking to having an impact in society, having an impact on the people that we touch.
And I want to circle back to you on getting more granular on that. Neri, you know, I read your report done by your two colleagues, which came out very quickly after the SEC. So you folks must have been hard at work. And you know, I've been following this since 1989, and I saw this from a different perspective than you did. You were just doing your job for your clients. I was looking at it historically, and I was going, "Holy cow! Here's one of the world's most prestigious advisory firms telling their clients that they are going to have to take very seriously their strategies for human capital management, their purpose, and to look strategically at the metrics that they should be using, as Solange said, to drive their business, not just for disclosure purposes. Otherwise, it just becomes a check the box game." And so from a historical standpoint, holy cow. So Neri, it seems to me that EY is determined that this is for real. You guys did a 12-page or 8-page report with very specific recommendations. What drove you to those conclusions, and how game-changing do you think this is?
So it's interesting because what actually drove us to do it is not the SEC. What drove us to do it is the evolution of where we are and what do we do with our clients and what we are seeing and what's important. The fact that we are a significant accounting firm and we look at reporting is an important thing, but the issue of reporting is secondary, right? Because you know, even if everybody fails in class and you report the class, you know that everybody gets a failing grade. So reporting to some extent is using an X-ray. And whether the X-ray helps you to heal, to walk away from a circumstance or some other thing, it's solely an X-ray. What we've done as a firm is we looked at the area of what drives long-term value, how you tie better reporting and measurement to decision-making. And then if you do it well, how in turn you can report it to your investors and broader stakeholders that just comes to a broader theory. So EY as a firm has been on this topic for quite some time. We've been involved with various initiatives to enhance the prospects for potential reporting in a variety of areas, working with academics and organizations such as yourself to advance it. And clearly, when the SEC or other organization coming up with requirements, we are simply placing it, to Larry's point, in a trajectory and where we are in the context of additional thinking. So for us, the SEC point is a yardstick, is a milestone. It's an important one, in particular, given the current administration pursuant to which it was issued. But I think that the point was made earlier that this is a trajectory. This is yet another building block. And by the way, the other thing that's important to recognize that while at times we think we live on an island, it's not always the case. There are other jurisdictions in which we operate and cooperate. And many of our clients are multinational. So irrespective of what the SEC does, if you operate in certain jurisdictions where some of those disclosures may be mandated, the SEC is important, but not as important because you may need to report it anyways in some other jurisdictions. Now, to Solange's point, I could not agree more. This is my own philosophy, it's my own view. It's not necessarily the view that's held by all. But I suggest the SEC establishing a starting point in a principled fashion is important because otherwise there could have been a compromise that will suggest that we may need to be shooting to the lowest common denominator or something we all agree upon. It could deplete innovation. And the fact that you always have the ability to start thinking through the SEC approach for comment letters, for additional guidance, for interpretive guidance to suggest, okay, we'll let you get out of the box. If somebody is either too speeding on a highway or is too slow or moving to the sides, they can always bring it to a mean. And you know, the markets can bring it to a mean. To Larry's point, the investor can bring it to a mean if they think that this is the intent of disclosure. Disclosure is not to bring everybody to a particular same point. The disclosures are actually allowing investors to discriminate in a capital market between investments. So the role of disclosure is not to suggest that everybody should be equal, or in fact, the disclosure should be there to suggest that you may be different than your competitors. How you're different, why you're different, hence the narrative in the MD&A and disclosure they need to provide it to the disclosure. So again, this is my own view, this is my own hope in a way, and time will tell whether we're going to get there and how quickly we're going to get there.
So you've revealed your secret. The reason you were able to do that report so quickly was that you were already, in a sense, working on it, which to me is even more significant. In other words, to you, this is an evolution, the SEC rules, and that in fact this is just good business.
Well,
Yes, and I would add to one thing. First, the SEC generally tips its hand because they say that the regulators are there, but also for me to be deserved to earn my pay and remuneration is if there's a significant role, whether I'm ready for it or no, I got to inform my clients. If I didn't do it, so sometimes I'm at the mercy of the regulators. Sometimes they give you a little bit more time. Sometimes it's been part of my trajectory, but I would suggest as a firm, this is what we're trying to do. If there's a significant issue for our clients, it's important. We try to make sense out of it. We got to translate it to action, provide them some information, and we continue to iterate on it. We're learning every day. The rules became effective on November 9th. For those of you that are very interested in it, you can go to Edgar Online. It's a free resource. Look at the most recent filings, and you can actually see what companies already starting. That there's about, as of this morning, between 40 and 60 disclosures already, and you can see that they run the gamut. There's a potpourri of practices and approaches that I think could be signifying some of the topics that we discussed here today, and this is directly out the box.
Well, this is great, Neri. By the way, I'm going to keep you guys disciplined because we have a time issue. Neri, we want to know where to find this. So what would people search for to find this?
If you simply Google, simple search, do SEC Edgar online, look for company disclosure, recent filings, search for 10K, and if you have the list of registrants, I can probably send you some links after the session.
Well, great. I'll share it with our community. Larry, and hold on, Solange, I'm going to get to you. Larry, the issue of materiality, I want to talk a little bit more about that quickly because I've been on the board, I've sat on the boards for some not-for-profits, and anything material gets our attention. And I think to an extent, and this is going to go to my question about critical decisions related to people, does this SC thing add to the legal burden of material? I know you're not a practicing attorney, perhaps you are, but you work for the Harvard Law School. The materiality affect the thinking of the board and of the CEO in terms of making decisions? Does it have any impact on, wait a minute, I really better double check this. This is 50% of my sunk costs are also 50% of my risks, and 50% of perhaps my unknown risks. And we've seen that with many mergers and acquisitions where a company bought another company burdened with unknown people risks. Do you think materiality has been raised in the minds of boards and CEOs related to people as a result of these developments, not just the SEC?
Well, again, first by definition, I mean, the fact that SEC regulation means that from a legal perspective, and then what follows from that, that entails demands on and expectations from companies, which have legal and other implications themselves. Second, this is a very litigation-free country, and there are lots of folks out there who are potentially litigants with regard to the lack of disclosure in light of prevailing legal standards. So that's also going to be played out. So,
and could this play out beyond public companies? The president or CEO of Bank of America, Brian Moynihan, said yes recently in a video. He said that you CEOs, he spoke into the camera, he said, you CEOs at small companies or private companies who think this isn't going to affect you, you're wrong. Everything we do at our level is going to trickle down. It could even affect what people pay for loans. Does that seem improbable? But I guess coming from him, it must be probable.
Well, no, I would expect that. I think there's already attention to other than publicly traded companies. I mean, there are a significant fraction of enterprises in this country employ a significant number of folks. So one way or another, I think there will be pressure, and that will be played out both in terms of on the voluntary side, that is external pressure to report, but also within whatever legal framework. That is, I'm not sure about there's legislation filed in Congress with regard to disclosure, independent of the SEC requirements, which arguably could apply to both publicly traded companies and otherwise. There's legislation which is being contemplated in California with regard to disclosure, not in the first instance investor-driven, but arguably would apply to all companies. So
we're right at the end of this, and there's a couple of important points. So those of you who want to hang on, please hang on. but this is just kind of too important, and there will be a recording, so if you have to drop off, we'll be sending everybody out a link. Neri, because I'm going back to Neri because Solange, I want to give you a big finish. You'll see why in a second. Neri, two things come to mind. I wanted you to get the agreement or disagree with Larry on this issue. That will this apply to most companies down the road? If I'm a private equity company, if I'm if I'm a private equity company or private company, will I be under more pressure, either from consumers, from employees? Do you see a trend where human capital disclosures?
Absolutely. So first, beyond the disclosure, COVID-19 had showed us what Gen X, Gen Z will be associated itself with, right? Broadly, beyond disclosures, we are attached to the pages of disclosure with the SEC, but we forget that disclosures come from different areas as well. If somebody wants to know how a company treats its employees, they can go to Glassdoor, they can go to some other thing. Clearly, it's not audited, it's not the same rigor. Somebody can potentially cook the books or the measure, but I do think we're getting more and more information from different directions that companies will need to validate and not validate. The other thing that's important beyond just and I think Larry, you alluded to it, some of the reasons that states going to regulate it and others, it's supply chain regulation. Like, well, who do you deal with? Who are your counterparts? So if I'm a very large company and I'm interacting with one of my largest supplier, and I could put in the context of perhaps the Biden administration and some things about climate risk, there's going to be some things, if you want to be a government contractor or some other things, you need to comply with certain standards. So I would say it's probably not the hours of education that you have for your employees, but either it's certification, it's human rights, it's certain thing. And by the way, this already exists in Europe. You need not go too far. Just go to Switzerland and look at some requirements that they're currently entertaining in the context of some private companies, and you'll see that. So I think some of it could likely be domesticated for sure.
So just now transitioning, we're going to get to you on this, Solange, as well. There was big news in the New York Times, or a big story in the New York Times today about retailers that are pocketing lots of profits as a result of the pandemic, and where they're putting that money. And a lot of that money is going back to shareholders and certainly is not going into pay. Now, we're not here to criticize a company's legal right to exercise its business. But Neri, you had said something in our prep call about agreeing that the companies are at the early stage of running their businesses the way Solange kicked off this show with, of having clear human capital dashboards against which they're measuring their business and looking to financial results. And, I think we all agree we're at the early stage of that. If so, are we equipped, and we can't speak for the individual decisions of publicly held companies, but if we don't have those kinds of dashboards, are we really seeing the impact of decisions like that? For instance, if we underpay employees right now, yeah, we'll get a better return for our short-term shareholders, but what risks are we kicking down the road? And I'm not asking you to say whether there are or not, but rather, if we're not measuring it, do we even know?
I would actually think about it as risk, but I also think the risk is missed opportunity as well, right? The one thing is a risk, but if you don't make sure that your machines are functioning to the most appropriate way, your output, your throughput and productivity will not be timely, will not be made to spec, and you're going to leave money on the table. So if you don't have the causality, and the other issue is, where do you spend the time? Whether, Larry mentioned the causality of education. What education? What's needed? And sometimes you invest at T0 and you reap the benefits. Even if you train me today, you may only know the consequences of where you invest and how, 2, 3, 4, 5 years, and you can learn from some other things. So some measures, and that's what we focus at EY in the discussion with the client, is how you think about capital allocation. What's not necessarily the input measures, but what's the output measures? How to think about the measures that translate to what is the leading indicator versus a lagging indicator, while recognizing that both of them are having a great utility in informing your thinking. And then at the end of the day, whether you can have a coefficient, let's say that this is the board of directors of a very large pharmaceutical company. Do we really have a coefficient of how much we need to invest in R&D today? And you say it's 1 times X, 2 times Y. No, there's some things that are enabling us to make a decision. Directing in R&D, directing in what areas we want to do it. But it's not a single number. So to your point of dashboards is a very instructive one. because it's a framework for thinking. It's a framework for capital allocation. It's a framework, again, the environment could change. There's some things you need to push in COVID and pull in different circumstances. And how you apply those levers, how you attend to them, how you have the ability to sit in a control tower and direct traffic and monitor that, in my opinion, that's the sweet spot. And it's managerial. And by the way, I think some of the risk is not the risk that something going to happen. The risk is something going to happen that you may be living significant opportunity unattended.
Oh, this is terrific. So Solange, she has set you up for exactly what I had hoped. I really want to end this program with the practical application. You were in HR management for more than years than you'll admit. And again, I have witnessed so much money wasted personally. Everyone will admit that there's almost no ROI applied to all of these expensive things, like, for instance, training. Training is only useful if it supports corporate purpose, if it supports the organizational goals. Diversity is only useful if it helps support. It's not only morally right, it's smart to draw from talent from more people, to have different perspectives, and to be able to sell to more customers. So there are always good business reasons for people management, and yet all of these programs are unmeasured. And so I'm going to hit you with this question. When you talk to many people at the front lines of this who sell services to HR people and HR marketing, you know what they'll say? Oh, there's no demand for any ROI. If you go out and try to sell that client on an ROI-based approach to their incentive or recognition program, the only thing they're measuring is, did people like it? Did they say they liked it? There's no rigor applied to 90% of these programs. That's my opinion. So my question to you is, Solange, do you see a time in our lifetime, and you're younger than I am, where companies really will manage to human capital dashboards that will take a longer view at the impact of decisions such as pay, and that they'll apply more rigor to the ROI of people investments than they're doing now?
I think it's summed up in two broad concepts. One is financial literacy. So most HR people, and I don't want to brush it with a broad stroke, but many HR professionals have zero financial literacy. And that's the thing that they need to understand, is that what they do in HR and what HR does as a function has a financial impact. And using dashboards helps connect the dots between the effectiveness and efficiency of HR programs and their impact on enterprise level performance. So the first thing is, we need to understand how our work in the HR function is actually impacting the organization. The second concept is around transparency. And that's what disclosures are meant to do, is to create an environment, a context of transparency. And it's not just transparency to the investor community and to the external user of information, but to the internal customer. Your employees need to know that they're being treated fairly, that the money that you're investing in them is generating not only a return for them personally, I'm gaining more skills, I have opportunities for mobility and advancement, but that doing what I do as an employee is actually creating benefit for the organization. And when you think about it, this is not a new concept, because that's how we compensate people. We give them goals. When they achieve those goals, we give them a reward. But the world is changing, and it's not just about cash or extrinsic rewards. It's also about intrinsic rewards. And the more we measure, right? Porter would say, we can't improve something we can't measure. The more we measure, the more we understand the impact on enterprise level outcomes. The more transparent we are, the better we're going to do as an organization and sustain that performance over time. Because it's not just short-termism anymore, it's about sustainability. And having information allows human resources and CFOs and CEOs to make more informed decisions. As Neri was saying, it's not just about avoiding the risk, it's about understanding the opportunity.
That's a great end. So I'm going to end. Well, Larry, I was just going to go to you so you can add your point. One quick question to each of you, and you can make your point, Larry. I want to ask, do you think we finally arrived at the era of human capital management, of true understanding and respect for the people asset of businesses, do you think we've finally turned the corner on this long quest that you and I have been on?
What I want to say is I think I have a slightly different perspective on what we're discussing, I think. Quite understandably, given the immediate focus on the SEC and the question of materiality, there's concern about ultimately company performance. But what I was alluding to earlier was, as I see it at least, the SEC, the event of the SEC doing what it did is part of a trajectory which had, in the first instance, little to do with company performance and little to do with investors. There were a range of folks who were concerned about workers and work and the implications for them. And in one form or another were attempting to drive change. There's an intersection of those efforts with the investment world, through pension funds and others. And that has given tremendous impetus to that. Right? So that in fact, the nature of what's driven it so far, right? And I think will continue to drive it, which tends to be left out, will be those other concerns front and center. Sometimes it appears implicitly in these conversations insofar as companies talk about reputation risk, legal risk, political risk, regulatory risk, okay, which implicitly involve normative considerations about what's in it for workers, what's the import for them. So so I think, what does that tell us? It seems to me that on one hand, this trajectory of efforts, and even the SEC, and what SEC has done, has put on the table most certainly disclosure as it has ultimate import for company performance. But in fact, both in terms of what's going to be going on forward, it will be looking beyond that, A, and in the very exercise of trying to determine financial performance, it raises the question about companies needing to rethink their relationship with workers. I'm not going to define that.
So would you say, Larry, since we have to move on, would you say that you're not agreeing necessarily with what the reasons are, but would you agree that there is an acceleration of this focus on people for a multitude of reasons that predated SEC?
Absolutely, but I think we miss what's the drivers behind this and its ultimate significance. Well, we need to look at both aspects. That's all.
And point well taken. Neri, your point of view from an accountant, right? You're a CPA. Is this really happening now, or is this going to be a fad that we're all going to look back on and say, it's all gone? The stakeholder capitalism epic that you've been working on, all gone. Is this going away?
I will answer as an accountant first. I've been around this topic for more than I'm probably willing to admit or want to remember. And I can only suggest that this time is real. If this time is real, it's been not only the US, and I'm not speaking about the SEC, I'm thinking about what we're seeing in Europe with the IFRS foundations and other things. There's much greater attention to it, and the stars are aligned because investors are interested in this. The ensuing circumstances of COVID-19, social unrest, what people are appreciating, looking at greater causality between performance and what do you do in treating your employees and communities. The other issue is we better measuring today certain things we could measure in the past because of the tools and the data and information and the evolution and actually even the elevation of the role of an HR officer within an organization to the C-suite in a much more prominent role. So it's not one attribute and it's not the SEC, it's the confluence of all those things that are just coming together, either amplified together or in a serendipitous time, they all come together. And I do think this contributes to my view, one as an accountant, from an accounting profession standpoint, the evolution of what we're seeing now with the actual confluence of harmonizing reporting, finding the right measures, the initiative that EY participated with the World Economic Forum on some measures that you mentioned earlier, but it's not only that. Many others, including the United Nations, the GRI, and others. So, and by the way, people paying much more attention to it. Those organizations existed 3 or 4, 5 years ago, but no one knew that they existed. Now, significant companies, CFOs, CEOs, regulatory entities starting to pay attention, and it's clearly for real. So the answer is long yes.
Well, so Solange, then you will get the last word here. What's your advice then to management? What's your advice to the advisory companies, the marketing, all these companies that sell these HR things and all these bright, shiny objects? And what's your advice to the HR and sales management that are trying to get their companies to spend money on all these things, and to advisory firms if we're in a new world now, don't we have to look at these things differently?
So to answer the first question, is it here to stay? I'd say yes, absolutely. And I'd say we're just getting on the entry ramp onto the freeway, right? We're just figured out where the ramp is. And I think that over the next 5 or more years, maybe not even, it'll take 5 years, this is going to accelerate in terms of its level of sophistication. We know, this is not a question, we know that human capital management matters in corporate financial outcomes and corporate performance. Now it's just a question of how do we advise our clients, how do we frame the issue, how do we contextualize the issue that makes sense for each one of our organizations individually, right? That's why it's principle-based. It's not prescriptive, check the box. Yes, I've reported on this. So what's my advice? Use technology. I mean, that's what's accelerating the change. Don't do it alone. There's no reason that you have to make decisions by yourself. Involve management, involve your board. I mean, boards should actually be driving these initiatives. And, you know, one of the things that Neri said is that this is not a single issue, right? Human capital is a multivariate function. There are lots of moving parts to it. And you have to think about it in its totality, not just looking through the training lens or not just looking through the diversity lens. Everything impacts everything. Take a more holistic approach when understanding the impact of human capital. Look at it through different lenses. Get advisors, get partners. If you're a CHRO, work with your CFO. If you're a CFO, work with your CHRO. This is not a single function issue. And use as much technology as you possibly can.
Well, thank all of you. Neri, could you please tell everybody the name of the study that you wrote so that they can Google it?
The
SEC study, the one that the SEC report, I should have done that.
I actually already chatted it. I chatted the link, and it's called How to Approach the SEC's New Human Capital Disclosures.
Perfect.
And then those of you who are interested in the whole concept of human capital metrics and reporting, Solange's HCMoneyball.com website has a lot of information on this. Larry is a consultant and expert. You can find him on LinkedIn on pension funds, as I said. And I thank all three of you for contributing to this message that can be summarized, I think, in the following quick overview: that human capital has become recognized as material, that organizations will benefit if they have a strategic and systematic approach, that it's an idea that you have to connect the dots between what you're doing rather than throw bright, shiny objects at it, and that all decisions, pay decisions, health decisions, and wellness decisions can benefit by applying a dashboard approach aligned against your organizational mission. And all of this is well articulated in Neri's excellent report, so I recommend that to everybody. And thanks so much for speaking today, folks. And thanks for those of you who are attending now or in the future. Bye-bye.
Thanks for having me.
Thank you.
Bye-bye.